Hello, Oracles, and the market seesaw swings down today. So as we were talking about this morning, we were not sure officially what was going on with Russia, if they were withdrawing troops, if they were putting more there. Well, it looks like they are fortifying their boundaries with more troops on the Ukraine border, and it looks like they are starting to push closer to the border. Obviously, the market reacted to this in a very red and negative way. So the NASDAQ was down almost 3%. Tesla was down significantly. Tesla did fill the gap down to 875 though, so if you want a silver lining, at least that gap is filled. We do still have a gap down to 846. Maybe we'll fill it tomorrow, maybe not. As far as I'm concerned with the macro environment, it seems like after the FOMC news that as much of the interest rates going up to 7 interest rate hikes for the year are priced in currently, because we got the news, we got the notes, they were the same as they were from the previous month, no changes, no market reaction. So that was a good thing. So right now the market reaction has to do with the Russia-Ukraine situation. Obviously that is not good for anyone involved. It's really frustrating the fact that 99% of the people, soldiers, citizens, nobody wants this. It's really just one person wanting this to happen, upset with things, and other people who are in leadership roles who are upsetting them in return. And it's a frustrating situation, war, because 99% of the people don't want it, and it has to happen because of 1 or 2%. It's ridiculous. But anyway, that's what's going on, so that's what we're currently dealing with. Whether it's actually going to happen and turn into an invasion or not has yet to be seen. We still have to see what's going on. I don't know if this is just a political battle game that is going on. We shall see. And so what will be interesting to see with the Russia-Ukraine situation is, will the market just keep going down? You know, I mean, there's only so far down the market's going to go. It's not like we haven't seen war before. As a matter of fact, for the last 20 years, most of those years, we were at some sort of war or conflict somewhere in the world. So it was going on, and obviously the market had its significant ups and downs, and we were on a very good bull run for the last 10 years, and we were still technically at war over in Afghanistan. So, you know, we'll see how this all plays out, how much it's going to go up and down, you know, how much is actually priced in. You know, if we keep on pricing in a potential invasion, you know, will an actual invasion cause the market to go down even more? Or is it going to be the reverse of, you know, buy the rumor, sell the news? So we'll see what happens when that plays out. Still, like I said, war has been going on numerous times. Stock markets continue to go up and down. So if we do happen to, unfortunately, go to war, it's just going to have to change our mentality. And it's not meaning that the stock market's going to keep on plummeting. Eventually we'll hit a bottom and we'll grab a new footing and figure out what's going on. I am obviously, like pretty much all of you out there, hoping that we do not get to that situation, because it's unfortunate for everyone involved. So let's hope we don't get there. And if that's the case, we'll just see some uncertainty, because one thing the market likes less than anything else is uncertainty. So, you know, when there's uncertainty in the market, regardless of what it is, that's usually when we see the pain. When we see answers and have clarity as to, all right, this is the situation that's going on, even if it is negative, like 7.5% inflation. When you see 7.5% inflation, that should be really bad. But when the market's already priced it in, then it doesn't really affect the market much. So the market's usually thinking ahead. So we'll see how this plays out over the next few weeks. Not really sure what's going to happen, but we do know that interest rates are going to be going up in the middle of March. So I have a feeling that even if we do get past this Russia-Ukraine turmoil and start to rally a little bit more out of it, I still think, despite the fact that pretty much all of the rate hikes are priced into the market already, when they actually do happen, there is still going to be that uncertainty, and we will see a little bit of a pullback. And with that pullback, I have a feeling that between now and probably the end of March, we will see the majority of these gaps get filled. Gaps across the board through the NASDAQ, S&P, so many different stocks out there that have had gap ups recently. You know, when you've got earnings and earnings are swinging stocks 20 to 30% on earnings, huge gaps are being created all over the place the market's in such a volatile turmoil that eventually it's going to settle out and all these gaps will get filled and will finally get smooth again, but it's going to take some time. And over that time, we're going to have more gaps that are created, more gaps that need to get filled. Don't forget, gaps go both directions. So if we gap down, that means that in most cases, the stock will still come back up to fill it. You do have to take a look at those stocks individually though and figure out why it gapped down. If it gapped down because the stock is, the company's going out of business or something, obviously that's not going to fill the gap coming back up. But if it's gapping down because of macro environment situations, or perhaps it was just sold off randomly because it had a good earnings beat, but they decided to sell off the stock, it's probably going to come back up and fill it. And so as we have talked about on here numerous times, best way to play this for long-term investors is going to be just dollar cost averaging. Figure out, and play it out long-term, because I know for me, I was playing out my $15 every percent that Tesla dropped, but I was running out of cash quickly because we're on such a roller coaster ride. So I had to alter my strategy a little bit. And so make sure that you're going to have enough cash to continue dollar cost averaging for probably the next 12 to 18 months. Not to say that we're not going to rally. I do think that we will see a strong rally to finish off the end of the year. But until we get all of the inflation in order and all of our interest rate hikes going up that we need to, we will probably still see some uncertainty in the market before we see a smoother bull run climb. So just make sure that you mathematically figure out how much cash you need on hand to be able to dollar cost average along the way for the next 12 to 18 months. Or find another way to get another source of income. That is something I have been working on, is finding other sources of income to make sure that I'll have enough cash flow coming in to be able to invest in dollar cost average for the next 12 to 18 months. And so my vision for the next 12 months or so in the stock market is a roller coaster ride, as we have said. So I think we're going to see potential turmoil. Obviously, the Russia-Ukraine situation right now is throwing it off a little, but we may see a little bit of a rally going into the end of February, beginning of March. Then we'll see uncertainty leading up to the FOMC meeting, leading up to the Fed decision as to the rate hikes, and then we will see a little selling off at that point. And then probably, maybe April or May, we will see a little bit of a growth coming back up. Inflation and CPI are going to play a role in whether we go up or down over those months. I think June we start to see a little bit of a rally going into the summer. And then by the end of the summer into September and October, we'll see a bit of a sell-off going into the midterm elections. And then after the elections, I think we're going to see a run-up into the end of the year. But I think that we are going to see swings very much like we're seeing right now. 2 and 3% every single day in the NASDAQ is going to probably be a norm for most of the year. And it's going to be crazy. And if we can string a few together, that's a significant run up or down, whichever direction it is going. And now I do know that there's a lot of negative possibilities that could come out of all of this situation with hyperinflation, with stagflation, lots of different things. We could hit a recession. So for me, the dollar cost averaging is what I'm going to do. But I think coming out of this, regardless of which one we hit, unless it's, hyperinflation and stagflation could make it worse. But even if we hit a recession, I think we're going to come out of this strong. You look back at history, regardless of what has happened over history, we have always come out of the situation at some point and gone into another bull run, and long term the market always goes up. So how long this is going to last, is all going to be dependent on how the Fed is able to handle inflation and get that down in line. Obviously, time will only tell as to how that's going to play out, but eventually we will get back to the point where we are going up and on a bull run again. Let me know in the comments below, how do you feel the next 12 months are going to play out, and what is your strategy and plan to get through this? I know some of you are playing options and you're doing quite well with those. I know some of you are flipping stocks in your IRAs. Let me know what your strategies are. Thank you all so much for watching. I appreciate all of your support and feedback. If you have not subscribed, please do so down below. Sign yourself up for notifications. I am over on Twitter at OracleTim1. I share all of the latest Tesla news, pertinent stock market information, and all of my daily trades. Thank you so much. Have a great one.